the process of addressing any questions that you may have as Newton goes through his presentation. And also, we've recorded this session, and this recording will also be available on our Mido platform, www.mido.com, for those who are not already on our platform, where we basically upload all of the content from the sessions that we have so that you're able to go back and refer back to them. But I think I've said quite a bit from my side. I'm going to hand over officially to Newton. Newton, you can take it away.
All right, mornings, everyone. Timkulu, thanks for the introduction. I trust everyone can hear me. Just let me know if my audio is good.
Yes, we can hear you, Newton.
Okay, fantastic. All right, thanks, Tinkulu. You always give me such a very good introduction that there's nothing more that I can actually add. I mean, it always makes me look very good, Tinkulu, and really honored to be part of the Mido family and to be able to have an opportunity to speak to SMMEs, and that's really something that I'm quite passionate about. Is helping SMMEs grow their business and scale their business so that they become the corporate giants of the day. And that is really something that I'm passionate about. It's always good to see when business owners, when they take up the challenge, they take up the mantle and the calling of responsibility to put together a business, take on the risk, provide employment for people, and really impact our country in such a phenomenal way. So, really thankful to be able to help the businesses out with the little snippets that I can give every now and then. So, thanks Nkulu, thanks Mido for the opportunity. So, just a quick summary about what we do at Future CFO. So, we're not say a boutique accounting and financial advisory firm, but essentially what we do is we specialize in cloud accounting techniques. We do your tax, payroll, all your basic compliance elements when it comes to the financial side of your business. But we then have the core offering, which is more of an advisory type role, where we do implementation of management accounts, financial advisory, helping you set up funding initiatives, those type of things. So that is pretty much the area that we specialize in. And this morning, I'm going to be talking a bit to you about compliance, right? So I'm going to share my screen. Let me know can everyone see my screen?
Yes, Newton, you can see the screen.
All right. Okay, fantastic. So I'm going to jump straight in. I'm going to try and keep it as brief as possible. I know that business owners taking away time from their core operation is usually a big sacrifice. And once again, thank you for being a part of this and actually taking the time to learn a bit more about compliance, because compliance is something which I find is generally something that business owners tend to have grudges against it, if I can put it that way, because it's not something that you decide to do generally. It's generally something that is enforced upon you. So it sometimes is not received with the best of hearts. And I can see that all of these business owners that are on the platform this morning they're really looking forward to see how can I start to comply and how can I be more compliant, which is really an honorable thing. So I'm going to jump straight into it. We do have a segment right at the end for questions and answers. So if you do have any questions, you can put it on the chat, and then we'll deal with those questions right at the end. So I'm going to jump straight in. So compliance, right? So what is compliance? And compliance is quite big. Compliance is not just one-dimensional. And I found a nice definition on the Financial Crime Academy that I think really sums up what is compliance. So compliance is the process of following or complying with all applicable laws, regulations, rules, and standards that apply to the entity. So whichever type of entity you find yourself in, or whichever type of business you're running, there are normally rules and regulations, there are guidelines, there are standards, there are There are ways that business is done inside of your sphere, inside of your entity. And compliance is the process of making sure that you follow all those rules and that you find yourself within the rules and regulations that is applicable to your entity. So I've got a nice picture here. And compliance, it can talk about laws. There's various rules, there's standards, there's policies as well. So let's say, for example, you work for a big corporate. A lot of the times they will have a lot of policies. So they'll have policies and procedures that you need to follow by. There's issues of transparency, governance, corporate governance that might apply to your entity, regulations, and also just general requirements inside of your entity. So the compliance as a big picture element is making sure that your entity or your business complies with all of those laws and regulations. And sometimes it can seem a bit daunting. So this morning, we're just going to touch on some of those elements that we felt was important to relay to SMEs, or also just compliance elements that we find quite regularly in the SMME space. So why is compliance important? And generally the answer is now compliance is important because if I don't comply, I'm going to get into trouble. So that's the general reason why people tend to want to be compliant, but there's so much more for compliance. So one of the things that makes compliance important is compliance ensures that your entity is not exposed to any punitive or corrective action, and that pretty much goes with the first point that I mentioned. Compliance is generally external parties that are enforcing various laws and regulation onto your entity. So if you don't comply, a lot of the times there's punitive or there's corrective action that tends to be instituted upon the entity. And obviously, in that case, if you don't comply, there's penalties and there's corrective action that sometimes gets instituted. Compliance also ensures that your entity is operating within the boundaries afforded to it. Now, within the business environment, we know that there's a lot of things that we can do, and there's also things that we can't do. And compliance ensures that we are operating within that sphere of operation that is given to us. And so for example, I'm going to use quite a technical example. Is that South Africa has got certain exchange controls regulations which limits the foreign currency coming in and out of the entity. And obviously in South Africa, we have our own laws and regulations, and we need to comply with those laws and regulations to make sure that we operate within the boundaries that are given to us by the law of South Africa, by the law and the governance of South Africa. So pretty much puts us in the box, but that's the box that we can walk in and that we can operate in. And I always say that you can walk on the outermost boundaries of that box as long as you're still in the box. Right. And compliance is also important. Generally, it also ensures a safe operating environment. So, for example, you've got health and safety compliance, you've got check compliance, you've got if you're in the construction industry, there's certain health and safety compliance requirements that you have to abide by. Otherwise, it opens up your entity to potential legal action, or it allows your employees to get hurt. And those are things that we obviously don't want to happen inside of our entities. So it ensures a safe operating environment. And the last point that I put on here is that the risk of non-compliance versus the penalty of non-compliance generally results in a net penalized position or a worse off position. And so I want to spend a bit of time on this because in my industry, we sometimes find business owners who are compliance averse because of the cost of compliance. And in their minds, they sometimes rather want to take the risk of not complying and almost continue to operate with someone looking over their shoulder. So for them, it's the financial benefits outweigh the cost of compliance. But generally with compliance, the risk of non-complying always puts you in a worse position. So let me give you an example. So for example, with that, if SARS finds out that you are not submitting your VAT returns incorrectly, they can charge a 200% understatement penalty, which sometimes results in a catastrophic payment that needs to be made to SARS, which sometimes can cripple your business. If the revenue service finds out that you are deliberately misleading or you are deliberately hiding things, if it does come out, that does come to light, and you are caught out, the chance that you lose a massive portion of what you built up is very, very high. So you want to walk a very fine line with compliance and see it for the way that it needs to be seen, and not I mean, not say play fast and loose with compliance, but you want to comply with everything that is relevant inside of your industry, because the risk of non-compliance is very, very high, or the penalty of versus non-compliance is very, very high. So, in my statement here, where I say does crime pay, I would say definitely not, because I have seen some of the punitive action that is taken against those entities who are non-compliant. And as much as I try to encourage them, the risk and the ultimate liability sits on the business owner. Business owner must decide to comply with all the relevant laws and regulations. So I'm going to chat about some of the administration behind compliance. So compliance is an additional administrative burden, and as business owners, most of the time we don't want to deal with administration, because administration is paperwork, it's documents, it's reading up on certain things. But compliance it's an administrative part of your business, which is almost as important as the core operations itself, because it protects the core operations from any sort of risk or any sort of incident. So it's almost as important as the core operations itself. So, for example, if say you're running a business and your business is doing really well, but you're non-compliant with laws and regulations, if it's found that you are non-compliant and they take punitive action, you can lose your business. You can lose the thing that you've built, that you've taken so long to build up, and we don't want to do that. We want to make sure that our businesses are sustainable and that they will be here for the long haul. Right? The key to compliance is to make sure that you comply with the regulations applicable to your entity or industry. So each entity or each industry has got their own laws and regulations. Some of them will overlap to various entities, but in general, each entity has got different laws and regulations that apply to the industry, and you want to make sure that you apply to those laws and regulations that apply to your entity or to your industry. And then we've got a thing of minimum compliance versus maximum compliance. So minimum compliance is making sure that you comply with everything that is required of you, and then you get maximum compliance, which is making sure that you comply with everything that you want to comply with. So there is optional promulgations, there's optional regulations that you do have option to comply with, but it's then up to the business owner to decide whether or not they're going to comply with this optional requirements as well. Regulations, they tend to change and adapt. So I'm sure all of you know about the minimum wage increase that happened last month, and it has been increasing every now and then. So it's important that each business owner is aware of the changes that impact your entity. So you need to be aware and you need to be abreast of what are those things that are changing from a regulation standpoint, from a law standpoint, that impacts my entity. The ones that don't impact your entity, that is not so critical. It might be good for information purposes, but you want to make sure that you know about those changes that impact your entity directly. Right. So some tips for compliance awareness. So reading or following industry-related publications and subscribing to industry newsletters where possible. So let's say you're in the construction industry and there's a website that normally releases publications, or they've got a feed, or they do videos. Follow and subscribe to those newsletters, because they will keep you up to date with any new regulations, any new possible laws that might come into operation in the future. Sorry, there's a bit of an echo there. I think someone's mic might still be on. Okay, I see it's gone now. Another thing that you can do is you can attend industry-related training programs or industry updates. So once again, each industry has got various road shows that they do around the country. Might be good to attend some of them. Some of them are webinars as well. So you might not necessarily need to go anywhere, but you can attend and listen in. And I mean, the digital age of today has made it so that we're doing this presentation, but no one is leaving the comfort of their office or their home environment. So there's a lot of things out there that allow us to stay abreast with related training programs or industry updates, and then also see what your CETA has to offer. So if you are registered with the CETA, your CETA generally has roadshows and or information updates that happen a couple of times a year. So it'd be good to attend those offerings as well. Um, Another thing that we can look at is membership with professional bodies, and they generally keep you updated on industry-related updates. So if you are part of a professional body, they will even let you know when regulation is in the process of being changed so that you're aware. And that's really a good thing to look at. Always good to have some sort of professional body affiliation where possible, and if it's relevant to your industry, they will keep you updated with any industry related updates. What you can also do is you can inquire of similar industry businesses. So the idea here is that you want to be asking businesses that are either larger or more compliant than what you are. So be good to go to businesses that are maybe bigger or more established and ask them, look, what are the relevant laws and regulations that's applicable to my industry that I should be aware of? What are the critical ones? Can you maybe give me some assistance there? And then they might be able to point you in the right direction. Something else that you can do is you can inquire of professional service providers. So this is attorneys, finance professionals, tax consultants, and industry related experts. So you can also ask them if you do have such service providers on retainer, or if you have access to them. You can always inquire of them as well. Something else you can also do, you can review notices on the government gazette. So that is obviously the hardest part, because it's most of the time legislation, and sometimes legislation is a bit tricky to read. And once you know what government gazette it is, a lot of firms and institutions, they sometimes offer summaries that just point out the main points of the legislation that you should be aware of. So, and obviously the internet has given us given us a lot of access to resource that we can then go and see what are the things that we need to comply with. Right, so compliance reporting. So compliance reporting should always be reported and documented in the form, manner, and timeframes required by the overseeing institution. So the overseeing institution will tell you, this is what I need, this is how I need it, and this is by when I need it. So we need to make sure that we are ticking those boxes and doing it the way that they want us to do it. Proof of compliance must always be maintained for at least the applicable retentive period. So I've made an example here. So you always want to follow the most stringent retentive requirements. So for example, the VAT Act says that documents must be maintained for a period of 5 years, but the Companies Act says it needs to be maintained for a period of 7 years. So in this case, we will need to maintain documents for at least 7 years. In that case, it will cover us for from the Companies Act perspective, and it will cover us for the VAT for the VAT Act in this example. The next thing that I want to chat about is something that I was actually thinking about in the early hours of this morning is anti-money laundering, and this is one of the topics that it's really come to the forefront over the last few years. And we'll see, I mean, for those who like to read financial news and like to read news, we'll see that South Africa was grey listed by the Financial Action Task Force, the FAFT, on the 24th of February 2023. And as a result, various legislative changes were implemented to address this grey listing. So essentially what it meant is that South Africa, the controls and the measures that exist inside of South Africa puts us in a vulnerable position when it comes to money laundering activities, when it comes to terrorist financing and those type of issues. And they've instituted a lot of additional controls to make sure that that money laundering operations are not in process, and that money laundering is kept to a minimum or actually eliminated as far as possible. So one of the changes included amendments to the Financial Intelligence Center Act, which has widespread implications, and we'll touch on some. We'll touch on some of those elements. So the question you're probably asking yourself is, what is money laundering? So money laundering is the process that criminals use to launder their funds so that the proceeds they have acquired from illicit or illegal activities appear to be legitimate. So essentially, money laundering, what it does is you take money that you've acquired through illegitimate or illegal means, and you put it into a system or process so that when you take it out again, it looks like it's legitimate. It looks like it was earned legitimately, and it was earned from a source, or from a source that is legitimate. So it's essentially the process of changing money so that it disguises the actual source of where this money comes from. So, and we're going to chat a bit about that today. So generally, money laundering, there's three stages of money laundering, and I found something from Comply Advantage, which I think really summarizes the three stages of money laundering. And some of this money laundering might not be applicable to your entity, but it might sometimes also be applicable to your entity. So it's important for us to listen in and to see, is there opportunity, is there a risk of money laundering taking place in my industry or in my business, or particularly relating to the customers and the clients that I deal with. So that's quite important to consider. So stage one of money laundering is placement, right? So the placement stage in money laundering is where the illegally obtained funds are introduced into the financial system. So it finds itself into the financial system. And it's often done by breaking up large amounts of cash into less conspicuous, smaller sums to deposit directly into the bank account, or purchasing money instruments like checks, bonds, money orders, or all of those things, and then moving it to other locations. So the idea with placement is that they want to take the illegally gotten gains or the money that they've earned, and they want to put it into a financial system, right? Some strategies that that placement includes, so adding illicit cash from a crime to the legitimate takings of a business, particularly those with little or no variable costs. So one of the premier ways that people put illicit cash into legitimate takings of business is they've got a business that is it's compliant, it's doing everything well, it's a legitimate business, and then they mix the laundered money funds with the legitimate funds. So in the case of a restaurant, for example, you can have legitimate cash sales from your customers, but there can also be illicit sales that is being mixed into the cash sales that looks like it comes from restaurant activities, when in actual fact it's not coming from restaurant activities. And it then requires quite a bit of digging and specialist knowledge to try and see what is the actual source of this funds, because the idea here is to disguise the source, right? Other placement methods include false invoicing. So you get a false invoice from someone and money comes into the account, and then if anyone asks any questions, you just show them the invoice, but the invoice is for goods that were never delivered from a company that doesn't exist. So that's also something that can also happen. You get things called smurfing, where small amounts of money below the AML reporting threshold is inserted into bank accounts or credit cards and used to pay expenses. So the anti-money or the FIC has got guidelines with regards to what that reporting threshold is, and at the moment that reporting threshold is 49,999 rand. So anything above that must be reported to the Financial Intelligence Center by reportable industries. So, and then what they do is they move money that's under that threshold, and then it doesn't really get detected, it doesn't really get reported. So they try to avoid detection in that way. Also, another thing, hiding of beneficial owner identity through trusts and offshore trusts. Now, I'm not sure if you've ever dealt with with companies that have got such a complicated ownership structure. One company is owned by another company that's owned by a trust that's owned by another trust that's owned by another offshore company. All of those take time to try and establish who's the ultimate owner, who's the ultimate person calling the shots here. And sometimes complex organizational structure also tries to disguise the actual beneficial owner's identity. So those are obvious. That's also another method that can be employed. And then also taking small amount of cash below the customs declaration threshold abroad and lodging it in another foreign bank account and then sending it back. So, like I said, South Africa's got various Reserve Bank regulations, and so now small amounts of cash are being taken out of the country, deposited in a foreign bank account, and then it comes back to you from overseas, and you never know where that money actually originated from. So those are some of the methods that happens with regards to money laundering. And then you get layering the funds. So layering stage is when the launderer moves the money through a series of financial transactions with the goal of making it difficult to trace the original source. Right? Sorry. And the funds could be channeled through the purchase and sale of investments, holding company, or moved through a series of bank accounts around the globe. Widely scattered accounts are also most likely to be found in jurisdictions where they don't cooperate with AML investigations. So moving funds into entities that don't have AML regulations, or well, in this case, South Africa didn't have very stringent AML regulations in the past, but now the regulations are catching up. So, and that is why all of these holes are being plugged at the moment. And in some instances, the launderer could disguise the transfer as payments for goods or services, or as a private loan to another company, giving them a legitimate appearance. So the idea here is that the funds are then mixed with other funds, and the idea here is to make it seem like it's legitimate. And this can be done by moving things around, buying this, selling this, so that it's so mixed so that you can't really trace where it comes from. And then the third step, which is integration. So the integration stage of money laundering is the final step in the laundering process. And this is when the launderer attempts to integrate illicitly obtained funds into the legitimate financial system to use to buy goods and services without attracting attention from law enforcement or tax authorities. The criminal then may invest in real estate, luxury assets, or business ventures. So step one was we put the money in. Step two, we mix the money up. And step three, we take it out as if it's legitimate and we spend it for whatever it is that we want to then spend that money on. So instead of just taking criminal gains and just going to buy a house, they then mix it into another entity, and then it gets mixed in with other operations. And when it comes out, it looks as if they legitimately received this money, and then they go and they spend it. And it then becomes very difficult to track this money, and very difficult to track what is the actual source of this money. Right? They're often content to use payroll and other taxes to make washing more legitimate, accepting 50% shrinkage in the wash as cost of doing business. So they might be willing to pay certain people, pay taxes, and so you might find a business that's completely tax compliant, has paid all of the pay, earned all the tax, all the VAT. It looks like a legitimate business, but in actual fact, it's used as an operation for laundering money or changing the nature of the money. Common tactics include fake employees, so getting money back, usually paid in cash and collected. So there's cash payments to employees. The employees have signed the register. There's copies of IDs, but they were paid in cash, so you can't trace it. Loans to directors or shareholders, which will never be repaid. Dividends paid to shareholders of companies that's controlled by criminals. So those are some of the tactics. And so just a quick summary of the money laundering compliance. So the three stages: you got placement, where dirty money is introduced into the financial system; layering, where the illicit funds are moved around to distinguish their origin; and then integration, where the money re-enters the legitimate economy through clean investments or through things that look as if they were legitimately obtained. Right, so this is just a brief overview of money laundering. It might not necessarily apply to your institution or to your business, but it's something that we need to be looking out for in the future. business owners need to evaluate whether they are at risk or being exposed to money laundering or have any reporting obligations as per the FIC regulations. So the FIC regulations, they included, last year, they included a whole lot of other entities which now need to register with the FIC as a reportable institution. And what I've done is I've just taken out some of the compliance obligations for accountable institutions. So this is just institutions that are accountable, but it's just good to know what are some of the procedures that the Financial Intelligence Center is recommending that accountable institutions need to follow in order to combat money laundering and also terrorist financing. So there might be certain things that we can implement inside of our business. And then obviously registration with the FIC, that is only if you are an accountable institution. Might be good to go and have a look through the definitions and see if your business falls into those definitions of accountable institutions that need to register. And then they obviously need to submit regulatory reports to the FIC, implement a risk-based approach. So the risk-based approach would be internally you say that when clients of such a nature comes in, the risk of money laundering is higher. So we then need to do some additional checks and balances in order to make sure that when we take on this client, it is a safe client. We need to develop a risk management, a compliance program. So how are you managing the risk of money laundering filtering through your entity? And how are you complying with the requirements of the Financial Intelligence Center? And then establishing beneficial ownership. So this is a good one for any business to do. If you are engaging with a client, and obviously certain industries, it's not possible, it's not practical or feasible to do so. So if you're running a restaurant, you don't require validation of beneficial ownership before you sell them a burger or give them a product. But if you are particularly in the service industry, it's always good to know who is it that you're ultimately dealing with, who ultimately controls this entity. So if you're dealing with a company, you could be doing work for a company, but never know that the company, through its ultimate ownership structure, is owned by, an overseas criminal or a politically exposed person or anything like that. So sorry, can you please mute your mic? Okay, there we go. Thank you. And then also conducting customer due diligence. So for bigger entities or for customers that you feel maybe there's a bit of a risk component in there, do a bit of a due diligence. Ask them for some supporting documents to verify and to make sure the legitimacy of the entity. And then scrutinizing clients against targeted financial sanctions list. So there is a financial sanctions list where there are certain clients in certain countries that have been identified with sanctions on them, and those are generally your high risk entities. Those are you want to really drill down to those clients and see, is there any risk involved in me getting into business with them. Determining whether clients are politically exposed persons. So those are PEP checks. They call them PEP checks, which is a politically exposed person checks. There is actually there's a few websites that do PEP checks where you just put in the name of the entity and then it does a worldwide search to see if this person is actually politically exposed. Is it a person that is of prominence in some government? Is it a person that is involved in a judicial system of some entity? So, and I mean, those all doing business with those type of individuals sometimes does increase the risk factor of taking on clients. So it might be good to do that where possible or where feasible. And then monitoring transactions and keeping records of customer transactions. That's a necessary step that we need to do. And then appointing a compliance officer, making sure that your employees know how to comply with various sectors if you are not the one ultimately dealing with the onboarding process. And those are just some of the guidelines that the FIC has given. So if you're not an accountable institution, there might be one or two things that you could say, okay, but this looks like a good thing that I can implement inside of my business. When I do business with clients, I don't really do a in-depth investigation to find out who is it that I'm actually doing business with. Who's actually the director? Are they politically exposed? Does this? Because ultimately, remember, you want to protect your own institution or your business from potential risk, and that is why these type of things are out there, and it is optional for us to then decide whether or not we want to comply with some of these if you are not an accountable institution. So the key here is not to be found as an enabler of money laundering. So we need to make sure that even though maybe we are not part of the money laundering activities, that doing business with us does not necessarily create opportunity for money laundering. So one example that I came across was a client pays you a deposit. So they pay you a deposit for work, and they make the deposits under the threshold. So a 10,000 rand a 50,000, but it's just cash deposits. And then after a while they say, oh sorry, but I'm canceling my service. I don't want to service anymore. And then you repay them money out of your kitty, and once it changes, it or disguises the nature of the money, because those cash transactions, you don't know where they came from. But yeah, at the end of the day, you are doing an EFT transfer to refund the money that they overpaid you. But the nature of the money came in via cash. So cash is a very risky item to be dealing with, and it's generally where most of your financial crime or your risk of money laundering occurs, is with cash transactions, because they're not easy to trace. And as I mentioned, cash payments, be wary of cash payments, and also the reporting threshold. I mean, I had an encounter with a client where he said that one of his customers. Sorry, can everyone still hear me?
Yes, we can hear you, Newton.
Can you hear me?
Yes, I can still hear you.
Okay. All right, fantastic. Let me just continue quickly. So, as I mentioned, we got to be aware of cash payments and make sure that we are careful when it comes to cash payments, and making sure that we don't expose ourselves to unnecessary risk when it comes to cash payments. Right? Let me have a look. Okay, next point. So then we've got compliance risk management. And so this is how do we go about, this is something that you need to do on the internal level. How do we go about making sure that we comply with the various laws and regulations? So compliance risk. What is compliance risk? Compliance risk is the risk that the organization's potential exposure to legal penalties, financial forfeiture, and material loss resulting from its failure to act in accordance with industry laws and regulations, internal policies, or prescribed best practices. So compliance risk is essentially the risk that you're not going to comply, and it's going to result in penalties and losing of assets or material loss. Organizations of all types and sizes are exposed to compliance risk, whether they are public or private. So it doesn't matter whether or not your business is big, small, massive, tiny, startup, large corporate. Everyone is exposed to compliance risk. You can be a non-profit, for-profit, state-owned entity, or federal, as they say in the United States. Organizations' failure to comply with applicable laws and regulations can affect its revenue, which can lead to loss of reputation, business opportunities, or valuation. So, like one of the things is, I know suppliers, there is a list of tender defaulters with Treasury, and those businesses or those entities, they are not allowed to do business with public institutions, because somewhere along the line there was either a non-compliance with laws and regulations that happened, and it has disqualified this entire business from ever doing business with government. So that's obviously one of the things that you need to make sure that you are managing. So what is compliance risk management? So compliance risk management is the process. So it has to be a process. It's not just a once-off thing. It's where you identify and assess and mitigate potential losses that may arise from the organization's non-compliance with laws, regulations, standards, and both internal and external policies, procedures. So there's generally a risk process that you need to take that complies with 3 steps. The first thing is conducting a risk assessment. So what is the risk that I will not comply with regulations in my industry? So you assess in your industry, these are the laws and regulations. What is the risk that I'm not going to comply with these laws and regulations? Then after that, you need to implement a risk management strategy. So it's practical procedures that make sure non-compliance risks are identified and addressed. So the risk of non-compliance, you identify what is the risk that I'm not going to comply, and what can I put into place that makes sure that I will comply. And then obviously monitoring in any process, monitoring is a key component. Compliance risk monitoring is assessing whether the risk management strategy is effective and in operation, and if it's achieving its goals. So to summarize, you conduct a risk assessment, see what are the risks. From that, you then develop a procedure that you're going to implement to make sure that you comply with the risk, and then monitor whether or not that procedure is effective or whether or not it's achieving its goals. So that's compliance and risk management in a nutshell. Then we get to some specific compliance elements, and some businesses tend to operate as companies. And I'm just going to the next couple of sections that we're going to go through. We're going to go through quite quickly in the interest of time. It's just a couple of key highlights with some of the more the more frequent we find non-compliance more frequently in these areas. So I'm just going to address the key items. Obviously, the Companies Act is quite a large act, and there's a lot of laws and regulations that is applicable to each company. But I'm just going to outline a couple of key elements. So the Companies Act number 71 of 2008 regulates all companies in South Africa, and it includes the following type entities. So it's private companies, Pty Limited, which is generally the go-to structure for new businesses in most cases. You got public companies, which are your big companies, which allow anyone to subscribe for shares in the entity. You got state-owned companies, which are owned by the state. You've got incorporated companies, which are companies that have joint and several liability of the directors. So the directors and the shareholders, they are liable for all the debts of the company. Then you've got non-profit companies, or NPCs, as they are called. What they call the new Section 21 companies. So if you've dealt with non-profit organizations or Section 21 companies in the past, this is what they are called now, NPCs, non-profit companies. So they are, and that is not the same as NPOs. The NPO is a completely different registration that gets administered by the Department of Social Development. So the key compliance objectives here with the Companies Act, where we find most non-compliance occurring, is that all companies are required to keep accurate and complete accounting records in one of the official languages of the Republic. So once again, it's more administrative, but according to the Companies Act, you are required to keep accounting records, whether that is copies of your sales invoices, copies of your purchases, bank statements, assets that you've purchased, general ledgers, all sorts of accounting records. It is required that each business keeps that. Each entity makes sure that they've got accurate and complete accounting records. First thing is that it needs to be accurate, but it also needs to be complete, which means that you don't want to miss transactions. You want to make sure that everything that needs to be included in your records are included in the records. And it's in one of the official languages of the Republic. Secondly, a company is required, and this is quite a contentious issue sometimes, that a company is required to prepare annual financial statements within 6 months after the end of its financial year. So according to the Companies Act, it's required that the company prepares annual financial statements within 6 months after the end of the financial year. Now, in the company's regulations, it then tells you also whether or not your entity needs to be audited. Does it need to be reviewed? Who can prepare your financial statements? There's a whole lot of regulations inside of that that tells you who can prepare your financial statements. And in certain cases, you can even prepare financial statements yourself. But it needs to then be in the format and the and include the elements that is required to be included in a set of financial statements. Right. Some other key compliance objectives is the maintenance of company statutory records. So that includes minutes of meetings. So if you do have minutes or board meetings, you have shareholders meetings, you need to maintain those minutes and you need to keep those minutes, particularly the ones where any key decisions have been made. Share certificates. This is one that I sometimes see tends to be absent sometimes. You've registered your entity, and according to you've registered the entity. You're the only director, but you don't have a share certificate. And if you don't have a share certificate, then proof of ownership of the business is not there. And so when you do go and register an entity, and if you do have an entity, make sure that your share certificate has been issued and that it meets all the requirements of the Companies Act for a valid share certificate, so that you don't sit with issues of having to prove ownership of a business at a later stage, especially when you involve different people. So now you expanding your enterprise, now you appoint someone else as a director, and in their mind, they are being appointed as a director, but they also are owner. And sometimes that also happens. People have misunderstandings of the positions that they sometimes occupy. So make sure that you've got your share certificates issued and that they are valid. And then the other thing that needs to be maintained is a company register. And that company register details all the information of the company. It's a registered office. Who were the shareholders? Who are the shareholders? Where shares been transferred? What was paid for shares? All of those things need to be maintained. Then an additional thing, which I think has come up to the forefront, particularly this year, a company is also required to file its annual return on the anniversary of its registration with the Companies and Intellectual Properties Commission, the CIPC. So what has happened in the beginning of the year is that every time you register a company, every year you need to pay a fee to the CIPC to keep your company alive. And the fees that is determined depends on the type of company and also the amount of turnover or sales that your entity is doing. And if you don't file those annual returns, then the CIPC will deregister your entity, which means that when you go and check on the CIPC, the bank will be the first one to call you. And they will say, listen, we see your company is deregistered with the CIPC. We are freezing your account. You can no longer transact on this account. And then things become quite complicated, because then you now need to prove to the CIPC that you were actually trading. You need to go and do a reinstatement application. And then after that, you then need to file all your annual returns just to get access to your account and just to get your business up and running again. So that's a very critical one, because the CIPC, they deregistered so many companies in the beginning of the year. They are actually on a drive now to deregister companies that are not compliant with their annual returns. And normally they would put them into a state, what they call deregistration process, if they are outstanding for 2 or more years. But then year 3, year 4, generally that is when you find that they deregister the companies. But now they're doing it 1, 2, 3 years. They're just deregistering your company. So that's a key objective. If there's anything that you take home from this, is that go and check if your company is compliant with the CIPC and make sure that it's still registered, because if it's not registered, it is in deregistration, which means you cannot trade with this entity. Right? So that's quite a key one. An additional requirement that they've put into, and this is also relating to the Financial Action Task Force report, is an additional requirement that they now want is the lodgement of beneficial ownership of the CIPC. So In the past, if you opened a private company, the CIPC had no idea who owns the private company, because share certificates were never needed to be lodged with the CIPC. But now what's happening is the CIPC wants to know who is the owners of this entity, or who's the actual natural person owners that own the entity but also control the entity. So they now need to know on an annual basis, when you submit your annual return, you need to tell them, okay, the shareholding structure has remained the same, or there's now new people that have entered in that have ownership or that have control over this entity, and you need to then lodge with the CIPC a register of all the people in your entity that have more than a 5%, they call beneficial ownership in the entity, or exercise beneficial control over the entity. So that's an additional requirement that they've added in since last year. But like I said, it's one of those items that come from the Financial Action Task Force ruling. And then we get to tax compliance. So I'm just going to put in the highlights, because tax compliance is a very broad, it includes a very broad scope, but I'm just going to highlight put in the main highlights of tax compliance. So when we're dealing with individuals, if you earn taxable income above the tax threshold, we're talking 95,750 Rand per annum, so that's per year, you must register as a taxpayer with SARS. So you need to get a tax number with it. If you are registered for income tax, you may need to submit an income tax return to SARS on an annual basis. So I know everyone has heard of, hey, it's tax season in July, I need to submit my tax return. And as soon as you hear that, then you know you need to go and ask yourself, okay, do I need to submit an income tax return? Is SARS going to request an income tax return to be submitted by me? And one of the big questions that come out there is, when will you not need to submit an income tax return? And in most cases, if you earn under 500,000 Rand for the full tax year, so this is from 1st of March to the end of February each year from a single employer, and have no other sources of additional income, so interest, rental income, if you're running a trade on the side, and you've got no deductions that you want to claim, so medical expenses, retirement annuity, travel, home office allowance, all of those things, then you don't need to submit a return. And you can see in this case, it's most of the time beneficial to submit the income tax return, because sometimes there is deductions that you might not have considered, or that you might not have thought of. And the thing with SARS is that SARS is not going to remind you or tell you that you need to submit if you've got a refund due to them. I had an instance with one individual. He was working for part of the year. So he worked for 6 months a year, and then he stopped working. Then he worked for 6 months again. Then he stopped working. Then he worked for 6 months. But each time he was working, he was paying pay as you earn. And so he came to me and he said, look, for the last tax year, I need to submit an income tax return because of X, Y, and Z. And so I asked him, okay, what happened in the previous year? What happened? And he says, no, I worked here, I worked there. I've got an RP5 for those years, but it's under the 500,000, so I'm not going to submit an income tax return. And I told him, no, but you shouldn't do that, because if you only work for part of the year, then you're even though they've deducted income tax, when they deduct income tax, they're supposed to deduct income tax based on what they estimate you are going to earn for the year. And eventually it came out that this guy, his income is for those last couple of years, I submitted his income tax returns for him, and he was actually due back like between 20 and 40,000 Rand of pay as you earn that he overpaid, because he worked for 3 months, then he didn't work, so his earnings over the year was under the tax threshold. So in some cases, chat to you if you've worked for part periods and you've paid some pay as you earn, go and chat to your accountant and ask them, look, is it necessary? Is there a possibility here that there's a refund due to me? And SARS is not going to remind you that there's a refund due, or I've never seen them remind anyone that there's a refund due to them. So that's something that you can look into. And in certain cases, you might also need to register for provisional tax. Right? So what is provisional tax? Because when I mentioned this, sometimes people don't understand what provisional tax is. So provisional tax is not separate from income tax. It's a method of paying tax due to ensure that the taxpayer does not have a large amount that he needs to pay on, he or she needs to pay on assessment, as the tax liability is spread over the relevant year of assessment. So to summarize what provisional tax is, so let us use the current tax year as an example. So the current tax year started the 1st of March 2024 and is going to end of February 2025. So that's the tax year. Now, normally what would happen if you're just submitting an income tax return, in July next year, you will submit your income tax return that includes all your income and your expenses from 1st of March this year to the end of February next year. And if you needed, let's say you needed to pay 100,000 Rand by that time, what SARS is saying is that from 1st of March to August, they want you to submit a provisional tax return based on what you think you're going to earn or what your taxable income going to be at the end of February next year. So they almost want you to pay half of what your estimated tax liability is going to be by the end of next year. It's a lot more trickier than I'm trying to explain, but I'm just trying to simplify it. But for people who get an IRP5, provisional tax is not something that you need to worry about. It's generally only for people who've got rental income or who are running trades that pay as you earn or tax is not automatically deducted from them. So those individuals where tax is not automatically deducted from them, provisional tax may need to be paid over to SARS on a 6-monthly basis. So let's say in August you pay 50,000 and in February you pay 30,000, then you've paid 80,000. Then when you submit your income tax return for that entire year and the assessment says you need to pay 100,000, then they credit you with the 80,000 that you've already paid. Then you just pay the difference of 20,000. And in certain cases, if your estimate was wrong and your income was less than what it should have been, then you get a bit of money back, right? So the key here is that you can't get a refund for income tax that you have not paid. So the key thing is that you must have paid the tax in order for it to be refunded. It requires taxpayers to pay at least 2 months in advance. There is a third payment that you can do, but that's outside of the scope of what we're dealing with this morning during a year of assessment, which is based on estimated taxable income. So chat with your accountant if you do have one. Ask them, is it necessary? Am I liable for income tax? If you are receiving a payslip from which tax is deducted, then generally no. If you have other trades or any other earnings that you are getting, then sometimes provisional tax is something that you need to consider. Right? Companies or closed corporations, all companies in recent years are automatically registered for income tax upon registration. So if you register a company today with the CIPC, it's automatically going to have a tax number. So that is something that the CIPC and SARS are doing. So they automatically allocate an income tax registration number. And all companies are automatically provisional taxpayers. So if you do have a company, know that you need to register, not register for provisional tax, you actually just need to activate it, and you need to make sure that your provisional tax returns are filed and paid every 6 months, right? They also require to submit annual income tax returns, and this is also where we see a bit of defaults, is that if your business is not trading, you still need to submit an income tax return. The income tax return that when you submit, you would just say there that either your business is dormant or it's not trading, and you need to give a reason why it's not trading. So if you do register a business, you still have a liability to submit an income tax return, right? And then also another thing that you need to do from a tax compliance perspective is if you do register a company, you need to also register what they call a registered representative with SARS. And if there are any tax practitioners or anyone who deals with tax, knows that has become such an onerous process over the last couple of months, and it is something that you need to do. Once you have a registered representative with SARS, SARS then knows who they can speak to with regards to tax compliance issues on behalf of a company. Right? VAT compliance. So you must, and I'm put in there not optional, register your business for value-added tax or VAT if the total value of taxable goods or services is more than 1 million in a 12-month period, or keyword here is expected to exceed this amount. So if you are of the opinion that your taxable income is going to exceed 1 million, then you need to register for VAT, right? And you need to then assess whether or not when you need to register for VAT, because you need to assess whether or not your business meets this criteria. And if it does meet the criteria, you then have to register for VAT. A business may also register voluntarily if the income earned in the past 12-month period exceeds 50,000. Now, I've seen some businesses decide to register for VAT. They've done over 50,000, and now one of their customers has told them, look, I need you to register for VAT. And now you register for VAT with the idea that you only need to charge VAT for this customer. No, you need to charge VAT to all of your customers if you are doing taxable supplies. So if you don't meet the tax threshold, the VAT threshold of 1 million, or you're not expected to meet the threshold, then you need to do an assessment as to whether or not it's in your best interest to register voluntarily for VAT, because that does come with a cash flow issue. It does come with a cash flow component, because every 2 months or 1 month, you then need to submit a VAT return. And if the amount of VAT that you charged is more than what you've collected or paid, then you need to pay VAT over to the revenue provider, whether or not you've got that money, which is a bit of a cash flow concern, because sometimes I've got clients that have issued out sales invoices, but they haven't received the money. They are then liable to pay the VAT on those sales invoices that they've issued, even though they don't necessarily have the money yet. So it does mess around with your cash flow. So something that one needs to always be cognizant of. If payment is required, late payment will automatically attract 10% penalty and interest on the outstanding amount. So this is, you see, one of those punitive measures that tends to catch up with you. 10% penalty. So if you're a day late, immediate 10% penalty, and that can be quite catastrophic. Right. I think we are getting towards the end of our time. So I'm just going to power through the next couple of slides. Pay-as-you-earn compliance. So according to law, an employer must register with South African Revenue Services, SARS, within 21 days after becoming an employer, unless none of the employees are liable for income tax. So if you've got employees that work for you and they earn over the tax threshold that we said is 95,750 for the year, you need to deduct employees tax from them, and you need to register with SARS as a pay-as-you-earn thing, or pay-as-you-earn. An employer who needs to register with SARS for pay-as-you-earn and or SL also needs to register to pay UIF contributions, and we'll touch on the UIF contributions as well. The UIF registration threshold. So if an employee works for more than 24 hours a month, you then need to register them for UIF, and that is a very low threshold. So that's essentially 3 days a month if they're working 8 hours a day. So the threshold is very low there. SDL registration threshold. So if your payroll is over 500,000 for the year, you need to also register for SDL, and that's skills development levy, and you need to make a mandatory contribution of 1% of your leviable salaries per month. And pay-as-you-earn returns are filed monthly and paid on or before the 7th of each month. And if you pay on the 8th of the month, 10% penalty, and then they start charging interest as well. UIF compliance. So these are just some things that I've extracted out of UIF inspections, which I think is just something that we all need to have available. You must have a copy of the act available for your employees, including the basic conditions of employment. Employment contracts must be in place. I cannot stress this enough. It protects you and it protects your employees. Employment contracts. Make sure that the employment contracts are in place and they are in the form and manner required by legislation. But there's no terms and conditions there that violates the basic conditions of employment. Payroll information must be maintained as well. So pay slips reflecting the required information, rate per hour, name, surname, ID number, all of those type of information. must be available. And then also proof of UIF payments. If you didn't pay the pay-as-you-earn via pay-as-you-earn submissions with SARS, then you can just pull your EMP 201s, as they call it, and that will show your UIF payments. And then also you need to maintain an employee personal file. And then last but not least, we have our workmen's compensation compliance. So Compensation for Occupational Injuries and Diseases Act 130 of 99 intends to do the following: to provide for compensation for disablement caused by occupational injuries or diseases sustained or contracted by employees in the course of their employment, or for death resulting from such injuries and diseases, and to provide with matters concerned connected herewith. So compensation, so what they call COIDA, that's the act, that's the acronym that they use. So if you have employees that work for you, COIDA is there to make sure that if they get hurt, if they get disabled, or if they die in the course of their employment, then they will then cover, or they will then get involved with compensating that employee or the employee's family in the case of death. And this is something that is quite key. People who businesses who deal with contracts or deals with labor, provision of labor, or you usually find that they need to have a letter of good standing with COIDA that needs to be submitted with any tenders or with any sort of manual or labor intensive type of engagement. So they will be quite familiar with this, and this needs to be submitted actually now in April, because it normally lapses every April of each year. So you need to make sure that your filing is up to date, your return of earnings has been filed, and that your letter of good standing is valid. Otherwise, no claims will be entertained from your employees, and it can be quite catastrophic for you to have to manage that yourself. So registration requirements: employers should register with the compensation fund within 7 days after the first employee was employed. And I can imagine that some people that have got employees would sometimes shudder when they read that, because one would not normally think that you would need to register with them, but it is a requirement to register with the compensation fund within 7 days after the first employee was employed. Right? And then an annual return of earnings must be submitted and paid before April every year. Right? And then just a quick disclaimer or notice that the information that we put in this presentation just serves as a general overview of compliance principles and highlights key areas. It is not intended to serve as a comprehensive guidance or substitute professional advice. Specific circumstances may require tailored approaches and expertise. Attendees are encouraged to consult with appropriate professionals or legal counsel for comprehensive compliance guidance tailored to their organization's needs and regulatory requirements. So essentially what we're saying is this is just a snippet. Like I said in the beginning, this is just a snippet of the compliance. It's always good for you to go and consult the specialist, or go and consult a professional to find out what are the key, particularly when it comes to tax and Companies Act. Don't speak to an accountant, speak to someone who's a tax practitioner or whoever that will be able to give you specific advice on your entity, as this was just an overview to give you snippets of the general compliance burdens that are faced by SMMEs. And I think that is the end of our presentation. And I think we've got some time for a bit of Q&A. Tim Kulu, I think we've got 30 minutes, if I'm not mistaken. Is Tim Kulu still there?
Thank you very much, Newton. Mtsi
Okay.
will take over from. Okay. I see we have a question in the chat. So there's someone who's asking if can I deregister for VAT when business is no longer making profit?
Okay. With regards to that question, look, remember, the require for VAT registration is not profit. The requirement is sales or turnover. So as long as your business is continuously doing more than R1 million worth of sales every year, then unfortunately you're not going to be able to deregister for VAT. If you do fall under that threshold, you can then apply to SARS to have your VAT number suspended, and they will then do an evaluation to see whether or not your taxable supplies is going to be over R1 million. But unfortunately, if it does go over R1 million, they are not going to allow you to deregister for VAT, unfortunately. But the key distinction here, like you've mentioned, is that it's not about profit, it's about sales. So SARS is not concerned as to whether or not you're making money on it. They just want to see if you're making a certain amount of taxable supplies or taxable sales, then unfortunately you will still need to be VAT registered, unfortunately.
Okay, thank you for that, Tembi. I hope you answered. And we also have a hand from Nomtandazo. Nomtandazo, you can just unmute your mic, then you can ask your question.
Morning, everyone. I just wanted to find out. You did mention something about having a share certificate. After registering your PTY, you mentioned the share certificate. So I just want to find out, the share certificate, is it the BEE certificate? Is that what you're talking about, or is there a different share certificate besides the BEE?
Okay, that's actually a very good question, because remember, with your BEE certificate, you are declaring what the ownership structure of your business looks like. But if you don't have a share certificate, you don't really have a valid proof to say who is the shareholder of the business, which will in actual fact, if you just look at it from a technical perspective, it will make your BEE certificate invalid. Because let's say, for example, I put in let's say I'm an EME, I'm under 10 million, I'm 100% black owned. So I go and I fill in my BEE certificate. I say I'm 100% black owned, but I don't have a share certificate that proves that I'm the actual owner of the entity. Then that affidavit is actually incorrect, or it's actually false, which in technical terms can get you into trouble. So the share certificate, all it does is it says, this is the owner of the business, this is how much shares they've got, and this is what the value of the shares is, or this is what they paid for the shares. So that's essentially all the share certificate does. And it only changes when you sell the business, or when you sell shares in the business, or when you transfer shares to other people. But it's completely separate to your BEE certificate, but it does relate to the information presented in your BEE certificate, depending on what type of entity you are. If you're an EME or a QSE that's 100% black owned, then the share certificate is the thing that you will use to determine what your ownership structure looks like. But in the event that you don't have a share certificate, you then can't prove what does the ownership structure of your business look like. I hope that answers your question.
Yes, I am answered. But then now, how do you get that share certificate? Because I actually thought the BEE was the share certificate. So now this was very great, because now I know, because I would have been really confused.
Okay, so the share certificate is actually quite easy. You can actually do it. You can do it yourself as well. You can go online and find share certificate templates, fill in the information, fill in who's the shareholder, how many shares they've got, and then you have to obviously pay for the shares. So let's say, for example, your business is authorized to issue 1,000 shares, and you subscribing for 100 shares at R1 a share, then you transfer R100 to your business. You say it's share capital, and then what you do is you complete the share certificate with your name and with your details, and the director of the entity signs it off, and then you've got your share certificate. There's many templates on the internet for a share certificate template that you can just customize for your own use, and then you keep that with your statutory records, and that is proof then of ownership of your business. Hope that answers your question.
Thank you so much. Yes, I am definitely answered.
Okay, glad to be of assistance. Any more questions or comments?
Thank you very much, Nomtandazo. Is there still any questions? You can still write them on the chat, or you can unmute your mic. Then Newton will be here to answer all the questions. Okay. I believe that is it. Newton, I'd like to take, okay, there is one question in the chat. So it says, I would like to know if the income tax only applies to the business side, not funding. The reason I ask is because I applied for funding from NAC, so I'm just curious if I'm still going to pay tax if I receive the funding amount.
So I presume that is that Mpo is asking regarding is it NAC or NPC? So generally, we're talking about non-profit entities, so non-profit companies or associations with the NPO number or those type of entities, if I'm not mistaken. Oh, national.
Arts
Okay, so you're getting
Council.
funding. Okay, so you're getting funding from the National Art Council. What type of entity are you running? Are you running a non-profit organization or you're running a profit organization, if I may ask? So is it a PTY limited? Is it an association? What type of entity is it?
But if possible, can you please unmute your mic? Then you can further communicate with Newton.
Hi,
Maybe
just
I
yeah,
go.
just to answer the question you asked. I'm running a PTY. Yeah, it's a PTY LTD.
Okay. Okay. So if you're running a PTY, the funding that you're getting from the National Arts Council, is it a grant or is it a is it a grant or is it a loan?
It's a grant. It's not a loan, but I haven't received it yet. So I was just asking in
Okay.
case. Yes.
Well, look, I mean, you would then need to look at the nature of the funding provided, because in most cases, what they call government grants, if it does qualify as a government grant, the government grant is not taxable for the purposes of what you're doing. So you'd need to go and look into the rules and the regulations of the grant. But in most cases, government grants is not taxable. So you don't have to pay tax on the money that you receive, because they give you money in order to run certain projects or to have certain outcomes. But it doesn't help if they give you the money and now you need to pay tax on the money. So in most cases, government grants are non-taxable, but you would need to go and look at the agreement, or if there's a transfer payment agreement or something like that, because that will generally say the nature of the grant and the rules and regulations applied to that. Hope that answers your
Okay.
question.
Okay, I understand. Thank you.
All right. Okay. Is there any more questions? No
On the
more questions?
chats, there are no more questions. I would like to take this opportunity to thank you, Newton, for making time for the workshop and giving us this insightful information. We really appreciate your efforts, and I would like to thank everyone who joined us for the workshop. We really appreciate it. We don't take it lightly for you to take your time off your businesses and come and listen to this insightful information that we have. Thank you very much, everyone, and I think we'll end here for today. Bye, everyone.
Bye. Thank you.
Bye-bye. Thank you.
Bye. Thank you.